Good afternoon, everyone. Welcome to today's episode of the Market Update with SRT Live. I am Sean Richard, your host. Thanks so much for joining me. And today we've got some fantastic information coming out for you. I'm going to talk a little bit about appreciation. We're going to talk a little bit about inflation. It's been a really hot topic. We got some numbers that came out last week, some data for inflation from last week as well as this week. Going to be talking about the housing market from, sorry, not the housing market, the labor market from a couple different components that came out. So going to update you on everything that is real estate. So tune in, stay here with me. We're going to go over everything so that way you can go out into the marketplace and be better educated, whether you're a real estate agent and imparting wisdom and information to your clients, or whether you're a homeowner and you want to better understand the housing market and the economy and how it influences not only you, but your house, your appreciation, your values, all of that. So let's get into it today. So first thing that I want to talk about is we had the initial and continuing jobless claims. So let's dive into labor. So we had initial, oh my, there we go. We had initial claims. Initial jobless claims. So these are individuals that are filing for unemployment for the very first time. And this was last week's numbers. And so the previous reading, and let me preface this by saying this comes out weekly. So the previous reading, we had 227,000 new jobless claims. This week, or I guess last week technically, the expectation was for 215,000 jobless claims. We only got 184,000. And this is the lowest number that we've seen in jobless claims on the initial report in over 50 years. So unbelievable. This really speaks to employers holding on to their employees. In this market where we've got a plethora of job openings and not enough people to fill them, then we're seeing employers hang on to employees. They're doing less firings, less letting employees go for just attrition purposes. So we're seeing employers hang on to employees instead of reducing their workforce. So continuing claims. So these are people that have already filed and they're just continuing to re-up on the unemployment benefits. This is going to be a bigger number because this is it represents kind of overall unemployment. So the previous reading from last week was 1.95 million. This week, the expectation was 1.90 million. We actually got 1.992 million. So up a little bit on continuing claims, but those initial claims down significantly below expectations. So what does this mean? How can we apply this to our daily lives? I mean, that's really what we want to understand. And so all of the labor market, I guess, shenanigans that we're seeing are really continuing the trend of wage pressured inflation. I mean, how are these companies retaining these employees? How are they keeping them from going? There's so many jobs open. How are these companies keeping their employees versus those employees going and finding a different or a better job elsewhere? And the short answer is a lot of times higher wages. So this is pushing us higher and higher on wage pressured inflation. And we'll talk a little bit more about inflation here in a moment. And so wage pressure inflation is a big deal. This trickles down into everything that we buy and all the services that we pay for on a regular basis. If companies are having higher costs in order to retain their staff, then that cost is going to filter down somewhere. There's a couple of different options for companies. Option one is they're just going to absorb the additional cost and their profit margins are going to shrink. Now, we all know that that's probably not likely the case. The alternative is these companies are going to pass this additional cost on to the consumers. And that's really what we're seeing. So that leads us right into inflation. So last week, we got the monthly consumer price index report from the U.S. Bureau of Labor and Labor Statistics. And there's a year-over-year reading and a month-over-month reading. And this is at the consumer level. So this is like a basket of, you go to the store, buy a basket of goods, they're reading the increase in price at the consumer level. So last month, we had, I guess not last month, we're in December. So October, we had a reading of 0.9 increase month over month. This month, I guess for November, the expectation was that we were going to see an increase at 0.7. We actually saw an increase at 0.8. So a little bit above expectation, but the key here is the year-over-year number. And the reason that's so important is because consumer price index is a rolling 12-month number. So every time we get a new reading every month, 13 months ago gets dropped off, or I guess 12 months ago gets dropped off. So when we see a very low number get dropped off and replaced with a high number, that has a pretty significant impact on the annual reading. So get this, folks. In October, we had a reading of 6.2% year-over-year inflationary numbers on the consumer price index. The expectation is that we were going to go to 6.8, and we actually hit that. We got 6.8. So we went from 6.2 to 6.8 on that consumer price index, that inflationary number, 0.6% increase. And that really speaks to the fact that we lost a lower number. And I apologize, gang, I don't have that handy. But 13 months ago, we lost a lower number. We replaced that with that 0.8 reading. So inflation at the consumer level is reading at 6.8% year over year, which is pretty insane considering at one point in time, the Fed didn't want to see inflation creep above 2%. And here we are at 6.8% year over year at the consumer level. Now, I had talked about companies passing cost on to the consumer. And so the next inflationary data that I want to share with you is the producer price index. So I just talked about the consumer price index. So that's inflation at the consumer level, going to the grocery store, paying for goods and services. The producer price index is your wholesale inflationary numbers. And I apologize, my camera seems to be very, very unstable on my lighting in here. Try and get that fixed for next time. So the producer price index is the wholesale inflation numbers. This is at the producer level. So inflation at the producer level, what it's costing them for goods. So that number, we have a month over month reading, and we have a year over year reading as well. And again, this is a month lag. So for October, our month over month was 0.6. The expectation for November was 0.5% increase, and we actually got a 0.8% increase. So again, this is going to have a massive impact on the year over year numbers. October, 8.6% at the producer level. The expectation for November was 9.2% year over year inflation. And we actually, because of that 0.8% month over month, we ended up spiking to 9.6% year over year producer price index. So inflation at the wholesale level. So again, this just simply speaks to it's costing companies more money, whether it's to retain employees, whether it's the cost of goods that go into manufacturing going up, whether it's the supply chain putting pressure on the cost of raw materials. All of that's playing a role in inflation. And we're seeing this both at the producer level and ultimately at the consumer level. You have those discrepancies though, because although producers are going to pass some of that on to the consumer, they may not pass all of it onto the consumer. So you've got a reduced level at the consumer, and that's again likely because they're not passing all of it. But majority of that cost increase is getting passed to the consumer. So again, you've heard me say this before, when you go to the grocery store, when you go to the gas station, when you're purchasing goods and services, we're seeing those prices rise. Now, on the flip side, wages are rising as well, so they're helping keep up with that demand and those rising costs on the goods and services level. So keep that in mind when you're thinking about inflation, but it is starting to run a little bit rampant. And so the Fed starts their meeting today. Their meeting wraps up tomorrow, and we're going to get their Fed interest rate decision, whether to the Fed meets And typically, for they meet to discuss monetary policy, make adjustments to the federal funds rate, and so they come out with a decision on the federal funds rate, whether to increase, decrease, and at this particular meeting, we could see an increase, but I don't know how likely it is. But the Fed is really going to come out, and Jerome Powell, Jay Powell, chair of the Fed, he's going to let us know kind of what their outlook is for 2022, if they're expecting to do any rate hikes to the Fed funds rate, and then the I guess the term of the year has been, or I guess the last 6 months has been tapering. Is the Fed going to taper? Now, I won't dive too much into this, but let me give you a quick overview of tapering because you may not understand or know what tapering is. So every month, the Federal Reserve, is buying bonds and treasuries, mortgage-backed security bonds, among others, and treasury bonds. And so they're buying new bonds, but then also bonds have a fixed life cycle, a fixed life term. So as bonds come due, the Fed is also reinvesting those bonds, the money that was in those bonds, into new bonds. So when the Fed talks about tapering, what they're actually talking about is they're talking about reducing the amount of bonds that they're buying new going forward. It doesn't reduce the amount of bonds that they're reinvesting as bonds come due. So they're still going to continue to reinvest that money in bonds and treasuries. They're just going to be reducing the amount of new bonds that they're purchasing, which will have an impact on the economy. It will have an impact on the mortgage and real estate markets to some degree, but it's definitely not going to be the significant impact that you may hear in the news media. So keep that in mind, and as you hear the news articles and news media talking about tapering, that's what they're referring to. So we're going to have a lot more information about the Fed's outlook on tapering and rate hikes in 2022. As of tomorrow, we're going to hear Jerome Powell speak. Now, one of the other reports that came out that I thought was really interesting was the CoreLogic equity report. So home prices across the country have been moving up significantly. You've heard me say this on previous updates. The Case-Shiller report, which is a home price index report, comes out on a monthly basis. The last report showed that we're at 19.5% increase in home prices over the last 12 months, year over year. And so if home prices are increasing by that much, then surely we must be seeing a healthy rise in equity. And that's exactly what we are seeing. So CoreLogic has come out with their Q3, their third quarter equity report, and they are showing that 31% increase in equity. That's huge. And if you're a homeowner, that's fantastic. That's massive. If you're a real estate agent, that is a great point to make to potential home buyers at the wealth building ability that home ownership has. So home equity, equity in homes, up 31% for Q3, which is amazing. So if you had $100,000 in equity, after 3 months, maybe you've got about 130,000. Crazy. The average gain in equity in Q3 was just over $57,000, which is amazing to think. So the average homeowner, $57,000 increase in equity. Now, bear in mind, you've got some homes that are worth, $5, 7, 800,000 $1 million homes. That those dollars are obviously much larger than your, say, $200,000 homes, $300,000 homes. So that skews that average a little bit. But the average homeowner up 57,000 equity in Q3. So if you're a homeowner and you're listening, you're watching this, if you've got some discretionary debts, credit cards, maybe even student loans, personal loans, and you're paying any interest rate on them that's maybe above 3-4%, you've got equity in your home and the ability to consolidate those other discretionary debts into your mortgage. And at first glance, that may not always sound like the right way to go. When it comes to debt consolidation, cash flow is the name of the game. We want to free up as much cash flow as we can on a monthly basis, because then we can take that cash flow and we can put that right back towards that mortgage and pay it off at a record pace. And if you have questions, you want to look at it, you've got some discretionary debt, you want to chat about it, reach out. You've got my contact information right there at the bottom. Happy to have that conversation, but it's pretty cool how much cash flow we can free up. So you've got the equity. Let's leverage that to put you in a better financial position moving forward. And then the last item that I'll touch on today is upcoming. What's upcoming this week? So we've got two major talking points coming up tomorrow. I already mentioned one of them. The Fed is going to finish their meeting. We're going to hear from Jerome Powell tomorrow, and we're going to hear about what their outlook is for tapering as well as rate hikes going into 2022. That's going to be a market-moving press conference from Jerome Powell, so we need to keep an eye on that. And then also tomorrow, we get the National Association of Homebuilders sentiment. So what this is they survey the home builders across the country, and they're looking for their optimism sentiment. And the median is 50. If we have a reading of 50 or less, home builders are not optimistic about the housing market and their prospects in the housing market moving forward. If the sentiment is at higher than 50, then builders are highly optimistic. And the reading from the last reading that we had, builder sentiment was in the 80s. So at an extremely high level. So it'll be interesting to see where that comes out tomorrow and how builders feel. But I'm guessing it's going to stay pretty high. And then I'll show you one thing, gang, a little extra for staying this long, is I want to jump out and I'm going to show you. Oh, let me make that a little bit bigger. Boom. So here's what's going on in mortgage bonds, and this is going to be a little bit deep for some of you, but stay with me. I'm just going to make a quick point. And so this is the chart of universal mortgage-backed securities. You don't need to know a whole lot other than this is a direct influence on mortgage interest rates. Now, I'm not going to give you rates today because they fluctuate every day, but what I want to show you real quick is I want to show you this trend line. So this line I drew right here, this green line that I just drew, so that trend line, mortgage-backed securities, although they fluctuate up and down on a daily or weekly basis, they have been trending down for a few weeks. At the top of that trend line, that is back on the beginning of November. So since the beginning of November, mortgage-backed securities have been trending down. And if you see at the very far right, we're butting up. There we go. We're butting up against that trend line, and it's been a hard trend line to break through. So if that pushes us down further, which mortgage-backed securities tend to move in the opposite direction of the 10-year Treasury. So if I pull up the 10-year Treasury, you see here we've got a long way to go before we hit any resistance in the 10-year Treasury. So if that 10-year Treasury starts to move higher, we're going to see mortgage-backed securities dip below this floor of resistance here, and that's going to push interest rates higher. So in the short term, I feel that we're in a position where interest rates are likely to go a little bit higher. And so if you're looking to take advantage of rates as low as they are, and folks, let me remind you that interest rates, even if they go a little bit higher, they're still in a phenomenal place. As recently as 2009, we were between the mid 5s to mid 6s, and the 45-year average of a 30-year mortgage is close to 8.5. So the fact that we're seeing rates still sub 4, in a lot of cases, is low as lower than in the low 3s to 4s, maybe even in the high 2s in some different terms like shorter terms. We're still in a phenomenal place. So don't get it twisted. Don't worry about rates rising a little bit. We're still in a great place. So if you have any questions, you want to follow up on any of the information I gave you today, don't hesitate to reach out. Again, my information right here at the bottom of the screen. I want to thank you all for joining me today on this episode of SRT Live with me, Sean Richard. You can see moving into my new digs in the background here, so a little bit less clutter next time I'm coming to you guys. But stay tuned next Tuesday for the next market update. Until then, gang, have an incredible rest of your week. Take care.